Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. And some of this is going to be a little bit of a repeat from last week that'll lead us to some really good news as we've been talking about, and as we keep moving along here with, we spent a lot of money, created a lot of inflation with the COVID relief stuff, some of the energy policies, increased prices, and that turned the interest rates to a higher level. When inflation goes up, interest rates go up, period, end of story. That's just the way it works. So let's take a look at what's going on with the housing market. Okay. All right, let's jump right in here. I'm going to share my screen. So payrolls rose. Again, when we're trying to tame inflation, that means what the Federal Reserve is trying to do, and whether you agree with it or not, is they're trying to tame the inflation costs that they can tame. They're trying to decrease inflation by, creating a cost to, using credit, spending money, all those sorts of things. Because of all the money that was spent, it created all this inflation. Now they got to dial it back. Okay. So always behind the eight ball, as we always talked about, all this information is always lagging from mainstream media, and a lot of this stuff. And keep in mind, a lot of this stuff is computer generated now. Well, from a lot of the mainstream media, and they just don't dig into the numbers. So we shared with you Barry Habib last week. We're going to share them again with you this week on the unemployment numbers that we saw the last week, this week, and what to expect at the end of Q2 and into Q3 and 4. And locally here in the Phoenix area, we're also going to share with you data from the Crawford Market report, which is our local gurus that are tied right in with our multiple listing service. The information they give us is so valuable because it shows us in detail where we are, where we're headed, and what to expect, and what the real news is when you dig into the numbers. So we're going to show you what's going on ahead of the curve and why we already hit the bottom of the market. Okay. And prices are set to rise. You can disagree with what we're saying. That's fine. We'll have to wait and see, but that's what's likely with all the information we have. Okay. So let's jump right in here and look at, so the mainstream media is telling us, this information here about the increase in payroll, which again, the Federal Reserve would look at it as, well, people are getting more money, they may spend more money. Not a good thing. They're saying unemployment rate increased to 3.6% above expectations, which actually, when they're trying to tame inflation, that means it makes it harder for businesses to employ. And so we see the effect of that. And again, this has all got to do with people spending. Remember, when people are spending or they're getting credit, now it costs more money to get credit because of them raising the Fed's funds rate. Now, that's not a direct correlation with mortgages, but it certainly has an indirect effect. But a lot of this is usually baked in, and the mortgage industry saw interest rates drop, went up again. So we told you this was going to kind of be rocky till we got to May, June. And that's exactly what's happened. But we did see when rates went down last couple of months, we saw a surge in mortgage applications. So it's going to happen when the rates drop, inflation drop. We're going to see this sort of thing just be fine. And right now we're just kind of in a slower neutral market until we get to that point. All right. So, here's what the mainstream media experts are saying. Likely by the end of the summer we'll see some relief, headed back to sanity, and and they're saying that in general we're going to see about 5 to 7% increases, which actually across the country is actually really good. Here in the Phoenix area, that's pretty typical or higher. And then, if they go on to say if interest rates go up, that's going to have an effect. And then, real estate is local, right? Every area is different. We have vacation areas, we have areas where people come and go seasonally and those sorts of things. So in the end, what they're saying, after a brief revival here in the application activity in January, when mortgage rates dropped down to 6.2%, there has now been 3 straight weeks of declines in applications as mortgage rates have jumped 50 basis points over the past month. Okay. No surprise there, right? So data on inflation and employment and economic activity have signaled that inflation may not be cooling as quickly as anticipated, which continues to put upward pressure on rates. Now, here is the reality of the employment, the inflation, and all that. And I'm going to play this again. I played it last week. It's just, a few minutes of the video, but I'm going to play this because I think it's super important to put all this in the proper context, because again, a lot of the information that you get from the mainstream media is not really digging in hard enough on the numbers. So here you go. I'm going to play this again.
So should you let high interest rates keep you from buying your dream home? Time for an expert. Last month, home buyers pounced on purchases when mortgage rates were lower than recent highs of 7%. Weakened home prices for the 6th month in a row. Now mortgage rates are back up. According to Bankrate, the national average for a 30-year fixed mortgage is 7.02% this week. The average 15-year fixed rate is 6.34%. There are a lot of numbers here. They do expect that these numbers will go down a little later in the year, but is it best to wait? Should you be just saving your money and dreaming and hoping that your time will come? Well, we asked Barry Habib, CEO of MBS Highway, an industry-leading platform for mortgage loan officers, to share the keys to home buying. Okay, so let's just get right to it. Should we buy right now? Can we buy? Is there a way to get around those high interest rates?
Well, thanks for having me on. And yes, I think that right now actually provides a very interesting opportunity. So we had seen interest rates dip just a little bit in January. And what happened? Activity sparked. And as activity sparked, we had multiple offers and sellers were less likely to give you a bit of a discount on that home. Now, what we have to understand is, why did interest rates move up during the month of February? You could trace it to the jobs report that we got that would appear stronger than expected, but it really wasn't. People thought it was a blockbuster jobs report of 517,000, but that actually came from something called a seasonal adjustment. In addition to that, there was something called a population control adjustment. It sounds like it should be in a sci-fi movie, right? So what is a population control adjustment? There were some workers that were undocumented that were picked up from 2022 that logically, to me, should have been reattributed to those months in 2022. Instead, they lumped them in to January of 2023. They weren't really created then. And as a result, the unemployment rate went down to what appears to be a 50-year low when it really wasn't. So the key here is to understand that when we get the March jobs, or when we get the report for February on March 10th, that will more than likely be more indicative of where the market is. Maybe rates begin to come down. And mortgage rates really depend on inflation to drive them.
Okay, Barry, real quick, you are way smarter than me. So I want you to tell me, like, bottom line, if I am trying to get a new home and it's just unfathomable to me to have 6% interest rates or 7% interest rates, is there a way that buyers can save the money that they need to afford the home?
Yeah, well, right now, what you could do is you can utilize a little bit of fear in the market to get the seller to not just drop the price, but instead of dropping the price, which they are more willing to do, use something called a seller contribution. Take that money and utilize it towards something called a 2-1 buy down. You can bring the rate much further or buy down your rate permanently.
Okay.
This will allow you to get a rate probably in the 5% range on a permanent basis, or below 5% on what's called a 2-1 buy down. Now that rate will go up. But if you believe, like we do, that inflation is coming down, that'll give you the opportunity to refinance. You could save tens of thousands of dollars in the price of the home and only spend a small difference in the difference in interest rate. So it's a smart opportunity to take advantage of that today, because if you wait till interest rates come down, and we believe strongly that they will by the middle of this year, then you're going to have very much competition, driving prices higher. And I think you'd be happier if you took the lower price today, slightly higher rate, than refinance and get the rate you want.
I love it. I love it. You made that so crystal clear. Thank you so much. 2-1 buy down. Google it right now. Very helpful.
All right, guys. So that gives you some really good insights there. And I shared that with you last week. I wanted to share it with you again because, interest rates did go up a little bit. Things are a little rocky, as you said, but I'm also going to kind of show you how this connects with our local market here in Phoenix, what the Crawford Report is saying about these things, and why he's definitely correct about our market. And again, he's a 3-time crystal ball winner, which means he's always right. There's a few times where, you know, he might have been slightly off only because the government went ahead and came out of nowhere and printed a whole bunch of money, you know, and those sorts of things. Again, if you know, get out of control spending by government, you print more money, you know, or people are going out and getting a bunch of credit. It just those are inflationary factors. Just the way it goes, inflation goes up, rates go up, period, end of story. So, all right, guys, the jumping into the Crawford Market Index, for this week, I'm going to show you a little bit of this first, and then we'll get into how this connects with what Barry was saying. So the market index is at 129.4. That's the exact number. You can see on a chart here how it's kind of progressed over the years and into those anomaly years, and how it's kind of dropped from the crazy insanity market we were in. Look how high that was. That was all the way up over 500 back in like 2021 into 2022. It was in the, you know, high fours, and then it dropped off. You know, again, those are anomaly years, you know, due to the information that we've already gone over a million times. So so that's where we are on that. Now on the let's see here. Let me just switch over to the next one. Okay, so on the demand, we are right now, we're at 82.8. Okay, and again, under 90 on the index is a buyer's market, over 110 is a seller's market. So we're at 129 overall. We're in a seller's market in the Phoenix area. This is for the Phoenix metropolitan area, all the cities within it, okay, in and around it. So this gives us an idea what's going on. We're technically in a seller's market, not a crazy insanity seller's market like we were before. Again, in those numbers that were in the high fours or in the fives, like I showed you on the last chart. But our demand is at 82.8. Again, complete balance would be at 100 on these index numbers. Or if it was matched up with supply, which it's not, we'd be in a balance, a completely balanced market. So they're about 18 points away from each other, and the supply has been low, which has kept things in order. Okay, so in other words, you know, we don't have an oversupply like we did during the crash. Everybody keeps talking about the crash, we're going to crash, but we just don't see that inventory. And a lot of people have been asking and talking about, what about new home inventory? Isn't that kind of sitting longer and stuff? And I'm going to talk about that more in a minute too. So on that inventory, you know, question, when we look at, you know, how things were overbuilt, to the point where, you know, new permits were coming in, leading up to the crash at like, you know, 4,000, up to 5,100 permits at a time, in a month, or for a year. We're seeing right now, you know, like for instance, back in March and April, things were around 3,800, and then rightly so, the builders dropped off their permits, and now we're down under 1,000, you know, permits being taken, you know, leading up to December of 2022 with the most recent numbers we have reported in January. So, I mean, that really shows that, you know, they've tapered off because they know things were slowing down during, you know, holidays, but then higher interest rates and everything. And that also gives us an indication on some other things in the market. Here is just real quick. Here is a look at overall numbers compared to last year on inventory. Again, inventory active listings, you know, are sitting a little bit longer, obviously, than last year on average. And we can see that, you know, prices have definitely dropped off a little bit, but there's kind of a summation again of the greater Phoenix area. And the numbers from February, market snapshot, so to speak, there. So let me pull out of this. And okay, there we go. Back to the big screen. All right. So right now, again, technically a seller's market. we're definitely, on the upswing there as far as the overall index. And I'm going to talk about why things are kind of leading us right into what Barry was saying in that clip I showed. But all of our cities except for Paradise Valley and Cave Creek are on the upswing as far as heading towards a seller's market. They're all moving up pretty strongly. The strongest markets right now on the upswing would be, or the top four would be Glendale at 25%, Phoenix at 21%, Avondale at 21%, and Gilbert at 27%. They're all over 20% on the upswing, and also Peoria at 23%. They're all on the upswing over 20% towards the seller's market. And let's see, we have wow, most of these are actually in a seller's market right now. Again, anything over 110 is a seller's market. So technically, Goodyear is at 96.6, and that's up 19%. And overall month over month, we're up, over 22%. So we're looking at, again, these upswings, and Goodyear at 96 puts them at a right in that balanced range. 100 would be completely balanced, but between 90 and 110 is that balanced range, right? And then Queen Creek, Maricopa City, and Buckeye are in buyers markets, but they're all on the upswing toward up over 10% or more going towards a seller's market. So that's a great indication that things are on the upswing. And here's something that the Crawford people pointed out, and then I'll tell you exactly how they explain this. But contract ratios that show across the greater Phoenix area, and properties, listed going under contract, how many are under contract, and all that, is at 60.4 on their contract ratio. So basically, what they're saying is this means, I'll read exactly what they say here, but it basically means that we're in a, technically anything over 60 on the contract ratios is going into a hot market. We're in a hot market. Okay. And here's exactly what they say. The contract ratios for all areas and types of homes has risen above 60 on the contract ratio chart. Okay. This means we are officially in a hot market. You should therefore anticipate housing prices to rise in the coming months, no matter what you read in the media, which tends to be based on reports and projections on housing data that's 1 to several months out of date, okay, such as the case with Schiller Home Price Index, okay, which is one that a lot of these use, okay, so they're behind the 8 ball, the lagging effect, especially with new homes, right? There's always that lagging effect of properties, being built under contract, what the inventory is, what's actually under contract, and then close. Okay, we're seeing less cancellations there too. Okay, but index, it says that such is the case with the Schiller Home Price Index. The opportunity to buy at the bottom of the correction occurred in the fourth quarter of 2022. Okay, so if you bought a home in the fourth quarter of last year, you hit the bottom of the drop in the correction of the prices. Okay, the price adjustments that we had, getting out of the crazy anomaly market with the interest rates going up and all that. You hit it just right if you bought in the fourth quarter of last year at the bottom. Okay, so congrats if you bought when everyone else was fearful, they say, about whether that was a good market timing. Okay, so again, this is in line with what Barry had said, and it was just a correction in the market. Again, a normal market is not like what we saw up until the first half of last year, basically, and the year or 18 months prior to that. Just those aren't normal. Okay, they're just not normal. So we've always got to keep that in mind. So when things are, we see a correction, we're still up, even though we saw a correction of that, as we mentioned last week, about 14 to 15%, we're still up overall about, that same amount or actually a little bit more in the greater Phoenix area. Okay. So according to the Crawford Report, let's see, this is taken from January numbers for February, and they said there were 5,910 closed sales, down 35% from February of 2022. Again, the crazy anomaly year that we were leading into, but 30% up from January. So meaning January of this year. Okay. So down from last year, but up over January of this year. Okay. There were 1,208 new home sales, down only 5%. Okay. Down a little bit, but less permits too, right? There were 4,702 resales, down 40%. Okay. Again, because just people, interest rates went up, the demand went down, and that's just the way it is. But again, the lower inventory has kind of kept us, from really bottoming out on our prices and still being ahead overall. The monthly median sales price was $440, down from 3.3 from February of 2022, but up from $439 last month. The new home medium sales price was $514, $776, up 7.8% from February of 2022. The resale median price was $420, down 6.7% from February 2022, but unchanged from last month. So once again, new homes are faring much better than resales in both volume and pricing, and these numbers are for single family townhomes and condos homes combined. Now, and this is taken from the 17 largest cities in the greater Phoenix area. So we, one thing I will mention that is a little different is multifamily homes. Multifamily homes, again, probably more like, your rental markets or investors for rentals. Those are actually, we have an oversupply of those. So you may see a little bit of a cooling there, but you also may see, rents, as rent supply goes up, we may see a little bit of a cooling off on rental prices for those still renting or those thinking about investing in those type of properties. So guys, overall, we're just not seeing the overbuilding that some people are saying, even though you can't really find any real sources for that. And the actual data doesn't show that the builders are overbuilding. That's not the case. They don't have an over permit issue like we did during the crash. We don't have an oversupply issue like we did during the crash. And we don't have poor lending practices that led to the crash because of that over inventory. They had these poor lending practices back then, and we just don't have any of those factors. Plus, people have more equity than they did back then. And, during a recession, always and every time, except for the actual crash in the housing market of 2008, we see that housing actually is always the bright spot. People gain in equity, because interest rates go down, demand goes up, everything becomes more affordable from the housing standpoint. A recession actually isn't a bad thing in general when you're talking about a general recession. Again, people may lose their jobs, and that could certainly affect some of that. But keep in mind, if our interest rates go down, like they're expecting, maybe 1.5% total points, then we're looking at, another 5.5 more million people coming into the affordability factor of being able to buy a home versus maybe losing. And unfortunately, it's the case, we may lose, say a million people may lose their jobs or so. We're seeing more people being able to afford a home that do have jobs or own a business. So anyways, guys, that is a quick wrap up on that. If you have any other questions, want to get more data about your zip code, your your community, subdivision, whatever, want to get more information about buying or selling a home and all that, we would love to be able to talk to you more and answer any of your questions. Reach out to us at 480-788-8569, or you could check us out at home@mincolagroup.com. Email us there. And you can always check us out at mincolahomes.com and mincolagroup.com. See you guys next time. Thanks.